Hey, what's up, my friend? So I remember in my early years, right, of stock trading, I was overwhelmed because there were just so many things, right, you can pay attention to. Things like earnings report, fundamental analysis, dividend yields, price to book ratio, technical analysis, chart patterns, support resistance, candlestick patterns. How do you know what to focus on? Because my attention could be easily diverted to any of one of these things. So along the way, right, after much trial and error, years of testing and research, I realized that there's only 5 things, right, that you must focus on and pay attention to if you want to be a profitable stock trader. So this is why in today's training, I want to walk you through step by step what are these 5 things. In fact, here's what you learn. You will learn, number 1, to know when to stay in the markets and when to stay out so you can avoid unnecessary losses. Number 2, you learn how to identify the best levels to trade on your chart so you can find low risk and high reward trading opportunities. Number 3, how to time your entry with precision so you buy only when the market is about to turn in your favor and not try to catch a falling knife. Number 4, how to cut your losses like a pro so you don't blow up your entire trading account. And number 5, how to know when to take profit so you don't lose everything due to greed. And along the way, I'll share with you a ton of charts, examples, illustrations so things will be crystal clear. Sounds good? Then let's get started. First thing first, number 1, I want you to pay attention to the stock market index. So for example, if you trade US stocks, pay attention to the stock market index. If you trade Philippine stocks, pay attention to the Philippine stock market index. If you trade Singapore stocks, pay attention to the Singapore stock market index. Why? Why is that? And the reason is simple. It's because in trading in stock markets, there's a saying which I find it to be true, is that a rising tide lifts all boats. So imagine, right, you're out at sea in the ocean. When the tide goes up, well, all the boats which are, floating in the sea or in the ocean, they goes up as well. When the tide goes down, all these boats goes down as well. So when you translate that into stock markets, when the overall stock market index is bullish, if let's say for example the Russell 3000, right, is heading higher, you can be sure that the individual stocks, right, more often than not, most of them are trending higher as well because the overall stock market index is in an uptrend. Make sense? Okay, so the key message I want to bring you across is that you want to buy stocks only when the overall market is bullish, when it's in a long-term uptrend, or rather when it's in an uptrend. Stay in cash, right, when it's bearish or when it's in a recession. Now you might be thinking, but Rayner, how do I know whether the stock market is bullish or whether is it bearish or whether should I stay in cash? That's a good question, and one simple technique I can share with you is to use a trend filter. So for example, if you trade the US stock market, you can benchmark against the Russell 3000. This is a index, right, which tracks, right, the largest 3000 stocks, right, in the US stock market. So if this index, right, the Russell 3000 is above the 100-week moving average, then you can say, right, that the overall stock market, the overall US stock market is in an uptrend. And if the Russell 3000 is below it, then you can say that it's a bear market and you don't want to be buying stocks anymore and you rather hold in cash. Okay, so let me give you an example. So this is the Russell 3000 index, right? So you can see that this over here simply is it tracks, right, the largest 3000 companies in the US stock market and is kind of represented as one individual ticker or symbol. For TradingView, it's under RUA. So if you just overlay with the 100-week moving average, in this case I'm going to change this to a 100-week moving average. Okay, so what you want to do is to make sure or to see whether this index is above or below the 100-week moving average. So you can see at this point in time, it's above the 100-week moving average, which is this black line over here. So this means that the overall stock market, the overall US stock market is still bullish and you want to look for buying opportunities in the US stock markets. And if you look at this over here, let's imagine now the US stock market at this point in time, it has collapsed. It has closed below the 100-week moving average. At this point, okay, you can conclude that, hey, the US stock market right now is bearish. We want to sell our positions and remain in cash. But if you look at this, over the long run, you will see that more often than not, right, it will keep you on the right side of the move more often than not. As whenever it's above the 100-week moving average, right, you can see that it tends to have a nice follow through towards the upside. Of course, there are times where we get caught, right, on like a correction, on a pullback. Times like this, and this. We might, have to cut short our profits or even cut our losses. But that's part and parcel, right, of this business. So again, look for buying opportunities when the Russell 3000 is above the 100-week moving average, and that's assuming you trade the US stock markets. If you trade Singapore stocks or Chinese stocks or Indian stocks, just benchmark against the stock market index that your stock belongs to. Number 2, stock structure. So here's the thing, just because the index is in an uptrend doesn't mean a stock is in an uptrend, because the stock can be in one of these 3 market structure: in a range, in a downtrend, in an uptrend. Now let me ask you, which of these 3 stock structure do we want to be trading in? Is it a range market, a downtrend, or an uptrend? So first, let me tell you which market conditions you don't want to be trading in. Downtrend is out. Why is that? Simple, right? If you know the overall stock market is in an uptrend, and I'll be honest with you, I'll share a few facts with you, or rather this fact is that stock markets, right, in the long run, they are in an uptrend. If you look through any price chart of the US stock market, S&P 500, Nasdaq, Russell 3000 whatsoever, you can see that they are in a long-term uptrend, and that's because the stock market is a reflection of the economy. So you know that the US economy, right, where it is today relative to where it was 30 or 40 years ago, things have improved so much, and this is why the improvement in the quality of life, technological advancement is reflected in the stock markets, and that's why the stock market is in a long-term uptrend. So if you know that the stock market is in a long-term uptrend, then why do you want to be buying stocks in a downtrend? Doesn't quite make sense, right? Because that stock, right, clearly is even weaker than the overall stock market, right? So why do you want to fight against the natural phenomenon of the market? So I strongly advise against buying stocks in a downtrend. If you're investing, that's another story altogether, but for trading, Next one, what about range markets? Again, for me, range markets, I would choose to avoid them as well. Why is that? Nothing particularly wrong with range markets, but the reason is because there are thousands of US stocks out there. Why do you want to buy stocks which are in a range or in a downtrend when you can select the best ones which are stocks in a uptrend? Make sense? You want to be buying stocks which are in an uptrend when the overall stock market index is also in an uptrend. This really would put the odds in your favor. Okay? So let me just share with you a few examples of what stock in an uptrend looks like. So if you look at this, these are a bunch of stocks that I've just kind of listed out over here. Look at DocuSign, right? Daily time frame. You can see that this stock is in an uptrend. PINS, stock in an uptrend. SUMR, stock in an uptrend. Tesla, stock in an uptrend. SQ, Square, stock in an uptrend. Trillium Therapeutics, stock in an uptrend. So you get my point, right? You want to be focusing, right, on stocks which are already in an uptrend and avoid, stocks which are in a range market, or avoid, stocks which are, declining lower. So for example, stocks that are declining lower right now is possibly, I would say, the airline stocks, or maybe just, how about some Wells Fargo or something like that. This is a bank stock. You can see that this stock is more of in a downtrend, right? Range market downtrend. So this is the type of stock that you want to avoid. So this is a bank stock, not an airline stock, because I can't think of any US airline symbol at this point in time. But you get my point. I want you to focus on stocks which are trending higher. Peloton, Nvidia. Okay, get my point. Next one, the third thing, area of value. So here's the thing. Just because a stock is in an uptrend doesn't mean you buy immediately. Right? It's like, meeting a girl for the first time and marrying her on the spot. Just because, you saw her for the first time, she's so pretty. Oh, I love you to bits. No, it doesn't work that way, because what if she's a psychopath? What if it's a transgender? What if, personality mismatch? So this is why you want to seek confirmation, right? Or rather, you want to meet her a few more times to get more clues, to get more idea about her, to see whether it's a good match. So same for trading, right? You don't want to buy a stock just because it's in an uptrend. What if it's already near the end of the uptrend cycle where it's going to make a reversal or pullback? You want to wait for confirmation, right? A few more, factors, right, that is in a line, right, to improve your odds. So the next thing that you want to look at is what I call the area of value. So this simply means, right, an area on your chart where potential buying pressure could come in. One fine example is an area of support. So for example, okay, this could be, as you know, we want to buy stocks in an uptrend. So stocks in an uptrend, and then it comes back into this area of support. Okay, so this is an area of support, area of value. So that's one. So let me share with you a few examples. So if you look at this one over here, DocuSign, right? This stock is in an uptrend, and you can see that this is the area of value, right? Area of support over here where potential buying pressure could come in. Support is an area where potential buying pressure could come in. Another example, right? TRIL, Trillium Therapeutics. So again, this stock is in an uptrend, and this is an area of support where potential buying pressure could come in. How about this? Zoom, right? So if you look at Zoom, right? Okay, so this one later on, right? That's one way, area of support. Next one, moving average. Moving average can also be used, right, to help you define an area of value where potential buying pressure could come in. And this brings me to this example over here on Zoom video. So if you look at Zoom, okay, and if you overlay with the 50 MA, you realize that, historically this stock, right, tends to respect the 50 MA. Tested once, twice, thrice, 4 times, right? There's a slight false break here, then it rallied higher, and then over here a 5th time slight bounce and then collapse. Okay, so the moving average can also be used, right, to define an area of value. And of course, that's not all, because you also have another example over here. This one here, you can see a CRWD, right? This is CrowdStrike Holdings, tested once, twice, 3 times like a false break over here, but generally you can see that the 50 MA, it's an area of value that you can reference against. So one thing to point out is that I said area of value, not line of value. So when you use moving average, when you use area of support, right, it's an area. So this is why you shouldn't expect the price to test the area of value to the tick, right? So you can see that in this case, it had like a mini false breakdown before it rallied higher. Over here as well, a little bit of chopping price action through this area before it rallies higher. So expect this to be an area of value, not a line of value. Okay, so that's the third thing to look for, the area of value. Moving on, number 4, entry trigger. So now, you know, you want a stock market index to be in an uptrend. You want a stock to be trending higher. You want to be looking for an area of value. And the fourth thing that you want to look for is an entry trigger. So this simply, right, tells you, or rather it's a signal, right, that gets you into a trade when the other market conditions are met. So let me repeat once again, right? So don't make the mistake of just simply looking for entry triggers on the chart. It's not how it works, right? An entry trigger is simply a signal that gets you into a trade when all the other conditions are met. If the other conditions are not met, entry trigger is useless. Make sense? You want to have the other conditions to be met first before you utilize the entry trigger as a signal to get into a trade. Make sense? Good. So here are a few examples of entry trigger. Number 1, it can be bullish reversal candlestick patterns like the hammer. So for those of you who are not familiar with the hammer, let me just briefly explain. So a hammer is a bullish reversal candlestick pattern because at this point is the opening price. This is the open. And when the market opened, what happened is that the sellers, right, they took control and pushed the price down lower, all the way down, right, to this lows over here. This is the lows of the day, right? And this extreme selling pressure where the sellers are in control, woohoo, right? Suddenly, the buyers, said enough is enough, right? And they start pushing the price up higher, all the way up higher. The buyers came in, pushed the price all the way up higher, exceed the opening price, goes up to the high of this days and finally closing near the highs of the day. So it opens at this price point and it closes at this price point. So if you think about this, right, market is open here. This is the low of the day, this is the closing price, and this is the high of the day. What is the story behind this candlestick pattern? Well, it tells you that at one point in time, right, when the price opened, sellers were winning, woohoo, woohoo, right? Then the buyers, right, suddenly went crazy, they went nuts, they took a lot of steroids, they pushed the price up higher to the highs of the day and closed higher. So you can see that, in other words, the sellers are overwhelmed by the buyers. They lost control. Okay, so this is what we call a hammer, which is a bullish reversal candlestick pattern, which tells you, right, that the buyers are momentarily in control. They're flexing their muscles, right, at this point in time. And of course, hammer isn't the only bullish reversal candlestick pattern. We also have another one called the bullish engulfing pattern. So let me just quickly walk you through this pattern. So again, the previous day you can see that here the sellers are in control. They close near the lows of this candle. The next day the market opened, okay, here, and then the sellers were still in control for for a few hours of the day. Came down lower. This is the low of the day, and then suddenly the same thing, right? Buyers just went crazy. They went nuts, right? Maybe they had an overdose of some whatever supplements that you can think of, right? And then the buyers pushed the price up all the way up higher, near these highs, right? And then finally closing near the highs of the day. So you can see over here, this is the opening price, this is the closing price, this is the lows of the day, this is the highs of the days. What is the story behind this bullish engulfing pattern? Very simple. Yesterday, the sellers were in control, right? They were victorious. They closed near the lows of the day. The next day when the market opened, okay, the buyers, right, took charge all the way and closed, right, the price near the highs of the day. So this can tell you it's a quick reversal, right, of sentiment in market. One day it's bearish, next day it's exceedingly bullish, where buyers are in control. So this is what we mean by the bullish engulfing pattern. And again, right, when I talk about bullish engulfing pattern, by right, the traditional textbook requires, right, the candle to engulf the entire range, right, of the previous day candle. But for me personally, I just define it as a candle, right, that covers the body of the previous day candle. So in this case, as long as the bullish engulfing pattern, it covers the body of the previous day candle, I would define it as a bullish engulfing pattern. So in a way, you can see that my definition is kind of more relaxed compared to the traditional definition of bullish engulfing pattern. And of course, that isn't the only way to define your entry trigger. There's another one, which is what I call the trendline break. So let me give you an example. Or before we talk about trendline break, let's have a look at a few candlestick patterns, right, to see how it looks like on the chart. So you can see over here, one thing that I want to point out is that examples from a textbook, right, is going to be vastly different from the real world of trading, because you have different variations, different nuances, right? It's like, you are looking on the Tinder app or, Coffee Meet Bagel, you look at the girl, right, or the guy quite handsome. When you meet in real life, why is it so different? Why isn't, what the textbook says? Why isn't it what the app says, right? You get shocked. So same thing for trading, right? I can show you textbook examples, but when it comes to live trading, you have to be prepared that it's not going to be exactly like what the textbook shows. Yes, you might have, a few textbook examples every now and then, but at the back of your mind, you must be prepared, right, that when it comes to the real world of trading, the candlestick patterns might look quite different from what you have learned. Okay, so let me walk you through a few examples. So if you look at this one over here, this is a Kirkland's. This, right, earlier we talked about hammer. This is kind of similar to the hammer, right? Some people call this like a dragonfly doji. It's like kind of like a dragonfly doji combined with a hammer. You would see that this body over here, right, is kind of, the body of this candlestick, this hammer, is smaller, right, than the body that what I've just shared with you. But if you think about the psychology of the market behind it, the concept is the same. It's pretty much telling you that the buyers are in control. At one point, or rather at the start of the day, sellers were in control, pushed the price near the lows, and then buyers took charge, pushed the price and closed near the highs of the day. Again, the concept is the same, but the pattern looks slightly different. Another one, right? How about this one over here? This is what we call a piercing pattern. It's similar to a bullish engulfing pattern. The only difference is a bullish engulfing pattern, it covers, right, the entire range or the entire body of the previous candle. In this case, you can see that this candle didn't cover the entire body of the previous candle. It covered about 3/4, 80% of it. But again, the message behind it is pretty much the same. Yesterday, which is this candle here. Okay, let me just walk you through. Imagine this, right? What happens is that, let's say if you're looking at this chart today, yesterday, right, sellers were in control. They pushed and closed near the lows of the day. But today, buyers stepped in, right? Suddenly, right, they took too much, beef, chicken, and steroids, and they pushed the price right near the highs of the day, right? Almost even matching, right, the opening price of the previous day. So this tells you that, hey, there are buyers stepping in, right, to buy at this current price. Okay, so have a look at another example. So this one here, okay, is what we call a bullish engulfing pattern. This one pretty much engulfs, right, the body of the previous candle. But as I've said, right, we don't just trade entry triggers in isolation, right? We have to wait for the other conditions to be met, and I'll share with you, what are the conditions. But for now, you have a good idea of, bullish reversal candlestick patterns, and we can move on into another one, which is what I call the trendline break. So the trendline break is a very useful entry trigger when the market is trending higher, when it's in a healthy trend respecting the 50-period moving average. So something like this, right? Market is in an uptrend. In an uptrend, you have pullbacks along the way. So the trendline break, right, simply buys, right, when the pullback has ended over here. And this pullback over here has ended, right? And you buy near the break when the pullback just ended. Now you might be wondering, hey, Rayner, how do you know when the pullback has ended, right? So let me just share with you a chart, right, to explain, how this works. So this one here, you can see the price breaks out of this resistance and then it makes a pullback. So at this point, Rayner, how do you know this pullback is going to end? So what you can do is when the market makes a pullback, you got to be patient over here, right? So one tip that I have for you to be patient is overlay with the 50 MA, right? You want the price, right, to come close towards the 50-period moving average first. Okay, so when it's close enough, right, then you have some kind of like candles to play with, right, where you can draw your trend line over here, which is what I call the retracement trend line. So what you want to do is just to connect, right, the highs of the candle retracement. So you connect from the highs, right, from this highs, this one here, and this one here. You can see that we have this downward trend line over here against the trend. So what we are looking for is for the break of this downward trend line, or rather the break of, we call this the trend line break. When the price breaks and close above it, we get long. So in this case, you can see the price on this candle, it breaks and close above the downward trend line. So this is what we call a trend line break, and this is an entry trigger for you to get on board, right, the trade. Okay, so this is another technique that you can consider. But sometimes I know many traders, they might prematurely jump the gun. So for example, if you look at here, some traders, they might draw it in this manner over here like this, and then you might say, hey, you know, Rayner, there's a valid trendline break over here, right? On this candle, there's a valid trendline break. Yes, I agree, there's a trendline break, right? This candle here is close above the downward trend line. But remember, I said that you want to be applying this technique, right, only when the price is near the 50 period moving average. When it's too far away, chances are, you know, the retracement, right, has, you know, a little bit more room to go down lower. So if you want to look for higher probability trading setup, right, make sure the trend line break, right, is occurring near, or rather occurs, right, where the price has, you know, almost retest the 50 period moving average. Okay, so that's one thing to share, the trend line break. Moving on. Exits, right? So we've talked about, you know, trending market structure, area of value, entry trigger. What about exits? You know, so when it comes to exits, right, there are two things to bear in mind. Number one, where do you exit if you're wrong? You know, I can share with you the best trading setup, the best strategy, all the stars to align, but the truth is there will still be losing trades. Okay, so be prepared for losses. And how do you actually set a proper stop loss, right, such that, you know, it's not too tight and you don't get stopped out, you know, on a slight pullback, a slight retracement, and at the same time, right, you know, your stop loss has enough buffer, right, to withstand any potential volatility spike in the market. Okay, so a quick tip that I have for you is that you want to set your stop loss, right, at a level which invalidates your trading setup. So for example, let's say we trade in markets in an uptrend, and let's say price comes into this area of value, this area of support. So needless to say, our stop loss, right, has to be at a level which invalidates this area of value, this area of support. Okay, so where do you want to put it? Is it just below this lows? Not quite, because remember, we say that support is an area of value. It's not a line, right? So what could happen is that this area that I've highlighted, it might be, you know, deeper or larger than what we expect. Maybe the area of value could be like this, where the price comes in a little deeper before it retraces up and reverse higher. So we want to give our stop loss, right, enough breathing room, right, and not get stopped out on such, you know, sudden spike down lower. Okay, so the way we want to do it is to give our stop loss, right, a buffer, right, to set it a distance away from the area of value. So how do we do it? So we want to, you know, our stop loss, right, ideally want to be somewhere about here. You can see that it's a distance from here to here, right? This is a buffer that we are willing to give this market, right? In case, you know, we can't define the area properly, in case the market pulls back a little deeper, right, we still have some buffer to play with and don't get stopped out of our trade prematurely. Now the question is, how do we know how much buffer to give? Because some stock could be trading, you know, hundreds of dollars, some could be $40, $50, and if there's no, like, you know, like a $5 fixed stop loss that we can use all the time, because volatility of the stock market change from stock to stock. So one technique I'm going to use to share with you is what I call the ATR technique. So let me share with you over here. Okay, so let me explain how this works. So what you want to do, let's look at TRIL. So again, if you look at this, for example, let's say market has come into this area of value, this area of support somewhere here. Okay, and let's say at this point, right, market is showing signs of reversal. Now you want to go long, right? Where do you put your stop loss? Do you put it below this low? Remember, Rayner says that, you know, this is an support is an area of on your chart, right? You don't want to set your stop loss too near where the price is, because it could just suddenly spike down lower and reverse higher. So give it some breathing room. So what you can do is just pull out the indicator, the ATR indicator. I have it over here. Just go to go indicators. You look for ATR, average true range, and this one will pop up over here. My settings is 20 period SMA. Okay. So what you're going to do is to find out what is the current ATR value. Okay, so you can see over here, it's about 83 cents over here. So what you're going to do is to take the swing low over here at this point, right, and minus 83 cents. So I'm just going to walk you through this quick exercise so you know how to set a proper stop loss. So what is the value of the swing low? So if you look at this candle, the low is about $11.93. So what I'm going to do is take $11.93, which is actually the low of this candle here, and minus 1 ATR. What's the value of 1 ATR? It is 83 cents as shown over here. Okay, so $11.93 minus 83 cents, that gives you $11.10. I know some of you have really good math and you're faster than me, and I'm a loser with this calculator, but yeah, I'm an old school guy. So your stop loss, right, will be placed at $11.10. So what I'm going to do is let me just duplicate this line. Okay, and I put this line now at $11.10. And I don't want to confuse you with the colors. This one, I just change this to black. Okay, so you know this one is showing the area of support, even though it's a line. And this pink color line over here is your stop loss, right? And what is the significance of this pink line? Very simple. From this low over here, you minus 1 ATR, which is this value here, you get this value over here, $11.10. And the low over here, as mentioned earlier, it was about $11.93. So 11.93 minus 83 cents gives you $11.10, and that is your stop loss. That's how you do it. That's how we do it. Okay, next one. Second part of your exit. Where do you exit if you are right? So here's the thing, right? You won't always have losers in trading. You might have winners from time to time. And now the question is, where do you exit if you're right? What if the market moves in my favor? How do I know where to exit my trade objectively? So there are a couple of techniques to this. Number one, you can, trail your stop loss and write trends in the stock market. But for the other technique, which is swing trading, which is what I'm going to cover, is I'll share more with you, right, on how to exit if you're right. And this is from a swing trading perspective. So for those of you who are unaware, right, swing trading, right, all you're trying to do is to capture one swing in the markets. So for example, if the market is in a range, you want to buy low, sell high, right? So you capture this portion here, one swing. If the market is trending higher, what you want to do is buy on a pullback, then sell on that on this up move higher. So again, you capture this one swing up higher. So this is what we mean by swing trading. So how do you set proper targets, right, such that you capture swings in the market? So the key thing here, the key phrase here is that you want to set your target, right, at a level, right, before opposing pressure steps in. So what do I mean by that? Simple. So let's say if you buy at support, okay, you buy at support. Right, now let me ask you, as the price hits up higher, where might selling pressure come in? I'm sure you would say that, hey, Rayner, I think that the selling pressure would come in, just in front of resistance over here. And you're right. You're absolutely right, right? If you buy at support, and as the price, approaches resistance, you can be sure that there are traders who are willing to sell at resistance, short at resistance. There were traders who might want to take profit at resistance. So if you want to capture a swing, right, you want to exit your trade before resistance, right? You don't want to, set your target over here or over here, because you have no idea whether the price could, break out of resistance and reaches, this higher level. So you want to be conservative down here. Remember, support, resistance, they are an area of your chart. So you want to set your target, right, at the early part of resistance, right? Book the profits, right, and let the greedy traders, have higher expectations, and eventually, the price doesn't reach their target. What happens is that you reverse back and stop them out for a loss. But because you're conservative, you set your target just before resistance, you manage to book a profit and capture a swing in the market. Nice. And by the way, if you're enjoying this video, smash the thumbs up button, subscribe to the channel, right? This way you'll always be updated whenever I publish content like this. Now that you've, understand the exits, right, let's have a quick one at this example again. So over here, let me ask you, let's say market, is at this area of support. Where might potential selling pressure come in, right? Let's say if the market now starts moving in your favor, where do you want to set your target profit? Well, we said that you want to set your target before opposing pressure sets in. So where might opposing pressure come in? This looks like an area of resistance. I think I better, look to sell my position somewhere around $16. And if that's your mindset, congratulations. You probably would have booked a profit, and then market now comes back to the area of support. But you'll probably, make some money if you followed what I just shared. On hindsight, of course, because this chart is cherry picked. So anyway, let's do a quick recap, right, before we look at some examples. Number one, index, right? You want to pay attention to the stock market index, because a rising tide lifts all boats. If the overall stock market is in an uptrend, you can expect individual stocks to be trending higher as well. Number two, stock structure. Stock can be in a range, can be a downtrend, can be in an uptrend. You want to focus on stocks in an uptrend because this is the path of least resistance. If let's say, you want to go from point A to point B, do you want to walk, do you want to take a bus, or do you want to drive a car? Of course you want to drive a car because there's less obstacles in your way. The journey is going to be much smoother. So take a car whenever you can, right? So whenever you trade stocks, as much as possible, buy stocks which are in an uptrend. Third thing, area of value. Just because a stock is trending higher doesn't mean you buy immediately, because it could be getting ready to make a pullback, a reversal. Just because you meet a girl for the first time doesn't mean you marry her immediately. Same thing over here. Fourth thing, entry trigger. What is the signal that gets you into a trade? We spoke about reversal candlestick patterns and the trend line break. And then finally, exits, right? Exit if you're right, otherwise known as your target profit, and exit if you're wrong, otherwise known as your stop loss. And if you think about this, right, this formula is what I call the I say formula. I say, okay? So let's have a look at a few cherry-pick chart examples to share with you this I say concept. So let's get started, right? Few examples, right? I know you love charts. Let's get started. So first one to look at is Peloton. Where are you? Here. Okay, so for this one over here, you can see that again. Let's assume that right now the stock market index is in an overall uptrend, right? So you saw earlier the Russell 3000, the weekly time frame, it's above the 100-week moving average. So we have, permission to look for buying opportunities. Now, moving on, individual stock, right? So Peloton, right now, you can see that this market on the daily time frame. All right, first thing, is this stock in an uptrend? Well, if you look at this, right, just zoom out a little bit, you can agree that, yes, Rayner, it's in an uptrend, right? Series of higher highs, higher lows. Great. So number one, we have the index is in an uptrend. Okay, that's met. Number two, stock is in an uptrend. Great. Third thing, right, we are looking for an area of value. So in this case, right, let's have a look closer to here. Do we have an area of value? So this one is quite interesting because number one, we have this stock, right, which retests this previous resistance, which could become support. That's the first area of value. Second area of value is this 50 MA, which have this confluence of this 50 period moving average. So you can see that we have multiple factors coming together. This area of value is at this previous resistance, which could become support, with, right, this 50 period moving average area of value. Nice. Next thing we're looking for is an entry trigger to get long. Is there a valid entry trigger? And for those of you who look at this bullish candlestick pattern, you're right, this is a bullish hammer. Okay, so you can enter on the next candle open. So now the question is, Rayner, where do you set your stop loss? So again, we want to set our stop loss, right, a distance away from the price structure. So if you know that this is an area of support, right, find out what is the swing low. This is a swing low, minus 1 ATR, and that is your stop loss. So I'm just going to walk you through this example one more time so you understand how to set your stop loss. So in this case, pull out your ATR indicator again. So you see that right now the ATR value is $9.43. So you can see that the ATR value changed, right, from stock to stock, because different stock have different price point and different volatility. So this is why we don't use a fixed dollar amount for stop loss. So $9.43. So what is the low of this this candle over here? The low of this candle is about $92.03. So we take $92.03 minus $9.43, which is 1 ATR. So this over here is the 1 ATR value, and this is the swing low figure, right? This swing low over here is $92.03, 943 is this 1 ATR value. And what you're going to get is $8.26. So once you have this $8.26, what do you do? Well, that is your initial stop loss. So if you just take a line over here, we can just put it here, change this to paying coordinates $82.60. Okay, then over here, this is your stop loss. So if you were to enter on the next day open, this is where your stop loss will be, which is 1 ATR below this low. Okay, so next day market open here, great. You buy, hit the buy button. Okay, and by the way, all this is just for educational purposes, right? Whether you make money from the stock markets or whether you lose money, clearly I'm not responsible. You're a grown up now. Take charge, right? And don't send lawyers my way. Don't send lawyers my way. So yeah, this is the opening price. This is your stop loss. Next question is, where do you set your target, right? Where might opposing pressure come in? So yes, I agree. This market is in an uptrend, but there will be selling pressure still lurking around. And if you ask me, I would say this swing high, this area of resistance is one possibility, right? So if you want to be conservative, I would say anywhere between $130 to before $140, that's a good area, somewhere about here. Let me just highlight to you this area. Around this area, right, would be a good area to look to take profits, right, on this this trade. So in this case, price slowly inching higher. Anyway, that's one example. Moving on, right, let's look at another example. DocuSign, right? So okay, so looking at this one over here, you can see that in this market, again, I'm just going to assume that the overall stock market index is in an uptrend, because it is, right? So let's talk about the stock structure. Number one, stock structure, is this in an uptrend? Yes, it is. Number two, is this at an area of value? Well, this looks like it's at this area of support over here. Great, this is at area of value. Number three, do we have a valid entry trigger? Well, this looks like a hammer, but it's red in color, right? So if you look at this candlestick pattern, it looks like a hammer, but this hammer, instead of green, is red. So what this means is that for the day, the price actually closed lower for the day, but for the traditional hammer, as you know it, it usually closes higher for the day. So is this a valid hammer or not, Rayner? So again, this is where kind of, discretion, subjectivity come in. To me, I would say I will still consider this a hammer, because if you look at this, the context of this candlestick pattern, you still have a very nice long lower wick, which, signals rejection of lower prices. This tells you that the sellers try to push the price lower, but will and the buyers overcome them and close near the highs of the day. So to me, this is still a valid bullish reversal candlestick pattern, even though it looks bearish. Okay. Next thing, where do you set your stop loss? Remember, 1 ATR below the swing low. So in this case, I will take this as the swing low, 1 ATR below it, probably somewhere here. I can look to enter on the next day open. What about targets, right? Where might potential selling pressure come in. If you look at this chart, right, I wouldn't be too aggressive and aim for this highs over here, because this market would have to face or overcome this obstacle over here, this swing low over here. So if you want to be more conservative, I would say, you can consider taking profits right before this swing low over here. Of course, if you want to go with advanced trade management, take half a position off here and the other half over here. I leave it to you, right? It's not the scope of this video, but for a more conservative level, this is good for you to consider taking profits. What's the outcome of this trade? It's not important, right? Because the process is what matters. So move on to the next trade. SQ Square. Okay, for this one over here, right? Same thing, right? What is the overall trend in this market? Well, this stock is in an uptrend. Great. Number two, do we have an area of value? So if you look at this, right, I want to point out to you somewhere about here. At area of value, do we have a stock trading at this area of value? Yep, looks like it, right? We have this previous resistance that could become support, right? I'm not even sure if the 50 MA supports, just let me overlay it. Yep, somewhere about there, nice. So you can see that again, similar to the earlier example, we have a previous resistance which could become support, along with the 50 MA, which could also act as an area of value. Next one, do we have a valid entry trigger over here? So you've just, this time around, we don't really have a candlestick pattern. We have this one over here, right? A potential bullish engulfing pattern, this candle here. But I probably won't trade it because due to the small size nature of it, right? But what we can do instead is to look for a potential trendline break technique, right? So trendline break, right? I'll just connect the lows all the way down here. You can see that at this point, this candle over here did break and close above the trend line. So that's a valid entry trigger to go long. So now what about stop loss? Again, the concept is the same. Identify the nearest swing low, minus 1 ATR, and your stop loss is probably somewhere here, I'm going to guess. Okay, enter the next day open. This candle open, you could enter over here on the next day open. Stop loss probably 1 ATR below this lows. Possible target, right, I would say before this swing high over here if you want to capture a swing. So for this trade, right, if you look at it from a risk to reward basis, right, this is your potential profits, and this would be your size of your stop loss, right? You can see from a risk to reward standpoint, it may not even be a one-to-one. So whether you want to take the trade or not, I leave it to you. Okay, so one more final example. Zoom. Okay, so for this one over here, same thing, right? What is the stock structure? Stock structure is in an uptrend. Great. Is it at an area of value? From the looks of things, right, we have the stock at this previous resistance, which could become support around here, and the 50 MA as well. Over here, we have a nice bullish close up higher. Okay, you can see a nice bullish close over here. So, yep, it could be a valid entry trigger to go long. Right, stop loss again, 1 ATR below this lowest possible target, I would say, is before this swing high over here. In this case, the trade didn't move much in our favor before it reversed and, stop us out for a loss. Okay, so this is just a losing trade to share with you that, things won't always go your way. Now, if you have enjoyed today's training, then you will love Price Action Trading Secrets. This is a 140-page physical color trading book, right, where you'll discover proven price action trading strategies that work. And you can get a copy at priceactiontradingsecrets.com. I'll put the link somewhere below this video so you can, learn more about it. So what is this book about? So this book, right, is in essence, right, helping you master, right, price action trading so you can be a consistently profitable trader without relying on news, indicators, or subscription services. So in this book, you will learn, right, things like support and resistance, how to draw them, how to tell when you will break, which are the best support resistance areas to trade. You'll learn about candlestick patterns, you'll learn about breakout trading strategies, reversal strategies, proper risk management, position sizing, and much more. And when you get a copy of Price Action Trading Secrets today, I'll add in a few bonuses for you. Bonus number one is a PDF version of Price Action Trading Secrets. So as you know, this is a physical book and it takes time to be shipped, right, from the US to your doorstep. So instead of waiting for a few weeks for the book to reach to you, I will send you a digital copy, a PDF copy of this book so you can read it instantly, right, the moment you invest in this book. Bonus number two, position sizing calculator. You will also get this position sizing calculator so you can manage your risk, calculate the optimal position, or rather the optimal position size to trade so you never blow up another trading account. And finally, bonus number three, I'll share with you this special webinar I did called Part-Time Trading Secrets, where you'll learn, right, how to become a consistently profitable trader even though you're trading part-time without quitting your full-time job. So all this and more, right, when you invest in Price Action Trading Secrets today. So how much is it, right? And really, if you're in the US, Price Action Trading Secrets costs $12.90. If you're outside around the world, it will cost you $18.90. And this is for the cost of the shipping and the printing of the book. And for whatever reason, right, if you invest in price action trading secrets and you find that, man, Rayner, this is not for me, I didn't get value out of it, no worries, because within 60 days, if you just drop us an email at support@tradingwithrayner.com and you find that, hey Rayner, this isn't for me, just let us know and we'll gladly refund you in full, every penny, right? No questions asked. And the best part, you can still keep the book and keep your bonuses. Sounds good? Sounds fair? Then just go down to priceactiontradingsecrets.com. This is the link over here. I'll put it below this video somewhere. Then just click any of this blue button that you see. For example, this blue button here, this blue button here. It will bring you to the bottom of this page at the checkout. Just fill in your details, your shipping address, and we'll get it to you as soon as possible. So with that said, I wish you good luck, good trading. I will talk to you soon.